We now move into the next part of the program and our host address. And I'm really pleased to invite onto the stage Didier Van Not, who's General Manager for Corporate and Institutional Banking from Westpac Institutional Bank. So in this role, Didier has global responsibility for Westpac's corporate, institutional and government banking relationships, as well as ownership of the debt product offering, the management of the institutional bank balance sheet and the industry analytics and insights function, so he's busy. But he also is the steering committee member of the Australian Sustainable Finance Initiative, chair of Westpac's Group Climate Change Solutions Committee, co-chair of the Institutional Bank's ESG Risk Management Committee, as well as the Institutional Bank representative on Westpac Group's Sustainability Council. So I think with those two streams of experience, he's uniquely placed to talk to us about sustainable finance in Australia and New Zealand. So please join me in welcoming Didier to the stage.
Thank you, Emma, for this lovely introduction. Keeps me busy. Good afternoon, everyone. Together with BT, Westpac is delighted to be the host sponsor for the IGCC Summit. I think we're barely about 40 minutes in, and we've heard from Emma, we've heard from the super funds, we've also heard from a government minister, and also from the United Nations about the need to take very urgent action to tackle climate change. Westpac is no different. Indeed, Westpac has long recognized that climate change is one of the most significant issues that will impact the long-term prosperity of our nation and our way of life as well. Managing this impact requires collaboration to limit global emissions, whilst at the same time taking steps to help the economy and the communities become more resilient. As a major financial institution, Westpac and the sector in general has a major role to play. In fact, I'd like to believe that our response to climate change has contributed to our ranking as Australia's most sustainable bank on the 2019 Dow Jones Sustainability Index. Now, today I'd like to cover three topics. The first one would be an overview of the sustainable finance activities globally, and I'll try to focus a little bit about Australia and New Zealand markets as well. Secondly, I'd like to talk about opportunities for the financial sector and banks like Westpac, and I'll touch on the emergence of sustainability-linked loans. And finally, I'll touch very briefly on Westpac's approach to climate change. Now, in terms of the state of sustainable finance initiatives, I'm pleased to say that we are seeing significant capital flows to fund green projects primarily. A good example of this is the labeled sustainable debt market, where total sustainable debt issued has quadrupled since 2015, mostly to fund green projects. What you can also see in the chart, the red bar in particular, is the emergence of sustainability-linked loans, which really began to boom last year. And I'll come back to that very shortly. That growth story is great news, but there's still an incredible amount of investment required to transition the economy, and decarbonize the economy in particular. That's precisely why over 50 central banks and financial supervisors, including the RBA, came together to say that a massive reallocation of capital is required to decarbonize the economy. They also added, as financial policymakers and prudential supervisors, we cannot ignore the obvious risks before our eyes. Further, various countries have responded to this urgency by setting up task forces to address the risks and opportunities of climate change in the financial system. They've done that in Europe, in China, the UK, and Canada. In Australia, as Emma said, a game-changing collaboration was announced early this year between Australian banks, insurance companies, investors, and various industry groups to form ASFI, the Australian Sustainable Finance Initiative. ASFI will deliver a roadmap which will include recommendations on how we can, firstly, mobilize capital to meet the Paris Agreement, enhance the sustainability, resilience, and stability of the financial system, ensure better informed financial decision-making by enhanced disclosure and transparency, and deliver a financial system that meets expectations of our community and our consumers. As Emma said, I'm quite privileged to be on the STECO of ASFI, and there's still a lot of work to do. But I'm pleased to say that the various working groups we've established are making great progress to plan for the transition to a more resilient and sustainable economy. ASFI will produce a key themes report for consultation later this year and all the issues to be addressed in the roadmap. You'll be invited to comment on that. Similarly, in New Zealand, they've set up a similar task force called Sustainable Finance Forum. And my colleague, Karen Silk in New Zealand, is co-chairing that initiative as well. In New Zealand, they have a zero carbon bill, which you may have heard of recently. And we anticipate this bill to be passed before Christmas. It sets up crucial architecture to create a pathway that will put New Zealand on a trajectory to meet its 2030 and 2050 targets. These are all very exciting opportunities, and the markets are watching very closely, with recommendations expected in both countries, in Australia and New Zealand, in mid-2020. Now, opportunities for the financial sector and for banks in particular, there's quite a few. You saw on one of my earlier slides that we could see the significant growth of green bond issuance over the past few years, and the Minister spoke about that as well. Australia is actually the 10th largest market for green bonds, and it keeps on growing. To date, we've issued almost $16 billion of green bonds in Australian dollars. As the Minister said, globally, we expect the green bond market this year to issue over $200 billion US. So the growth will continue. And even a few months ago, Westpac actually was the first New Zealand bank in New Zealand to issue a €500 million green bond, the first one ever in New Zealand. But what I'm most excited about is the emergence of sustainability-linked loans. I believe that this market has the potential to outrank and outpace the green bond market. Unlike green bonds, where proceeds have to be deployed for very specific projects, a sustainability-linked loan can be raised for general corporate purposes by any company in any sector. Very different indeed. A sustainability-linked loan incentivizes a borrower to improve its sustainability performance, and in return, the borrower will receive a reduction in margin if specific sustainability criteria are met over the life of the loan. Essentially, it incentivizes borrowers to change behavior. As you would expect, it works both ways. The borrower will have to pay a penalty if their sustainability performance deteriorates. Whilst investors, and many of you in the room here today, have long had a tool of engaging and voting to shift a company's behavior, banks have never really had that before. This is really a quantum shift for the banking sector, as we can basically drive a change in behavior with our clients, which we're looking forward to. This type of structure is only about 2 years old. It started in Europe. Europeans have always had the edge and the innovation in this space. And it was soon picked up by the Asian markets, in particular the agriculture sector, where we've seen some very innovative solutions in terms of those sustainability-linked loans. More recently, earlier this year, the Australian market latched on, and the airport sector in particular was the first sector to embrace this new product. In all the conversations I'm having with clients today, you will hear much more about this market going forward, as all the sectors are showing an increasing amount of interest in this innovation. Finally, I'd like to touch on Westpac's approach to climate change. Our strategy is largely informed by the climate change scenario analysis carried out over the past few years, looking at both the transition but also the physical risks of climate change. We have a $10 billion lending target for climate change solutions, and we've already met that target early this year. Taking this further, we've pledged to more than double it, committing $25 billion by 2030. We've also made our target to facilitate climate change solutions in the amount of $3 billion through the issuance of green bonds or underwriting of green loans. Further, we issued that was last year, the world's first certified green tailored deposit, which continued to see strong investor appetite. We did win some global accolade for the issuance of that product, and as I said before, we're seeing more and more demand for that product. Aside from finance, we also manage climate-related risks through how we procure our energy. Earlier this year, we announced that we will be sourcing 100% of our energy needs through renewable sources by 2025. The first phase will be achieved through a power purchase agreement with Bowman Solar Farm, which is a new station to be built in Wagga Wagga. To finish up, I just want to say how pleased I am about the global attention being paid to this important topic of climate change and action in particular. We have a very receptive audience to this issue across the financial sector, and it is something that we take very seriously at Westpac. We have long realized that climate change is an economic and social issue, as well as an environmental issue. And we have an important role to play in managing the risks and opportunities in the transition to a net zero emissions economy. Thank you.
I'm just going to take the opportunity to ask a couple of questions. Didier, seeing that you've been in the finance sector for 20 years now, and seeing that this is an issue that we've been grappling with for 20 years now, what kind of changes are you actually seeing from your perspective as a banker in terms of how financial markets and your clients are actually thinking about the need to act on climate change? How is that shifting? How has it shifted over the last 20 years as well?
20 years. A lot has happened in 20 years, Emma.
Cause an existential crisis.
No, that's okay. So 20 years ago, Emma, we didn't talk about sustainable finance. At best, maybe we spoke about renewable energy, and we spoke about let's fund a hydro facility, or thereafter it was obviously the emergence of wind farms, and thereafter again it was solar farms. So we've come a long way. But I would call that the first wave of sustainable finance. The second wave was when the green bond market actually developed. The green bond market has been really good for us, and the reason why I'm saying that, when I say us, it's all of us, it's the sector in general, in tackling climate change. And the reason why the green bond market was so good is because for the investor, there was no additional risk. If you wanted to buy a green bond, the underlying risk was the risk on the borrower. It was not a dedicated risk separate to that. That was good. Secondly, because those bonds have to be labeled and certified by independent parties like the Climate Bond Initiative, suddenly the whole narrative started to narrow down, and everybody started to talk the same language, which made it a lot easier for people to come to grips with the complexities of the emerging green bond market. And thirdly, I also believe that initiatives like, of course, the Paris Agreement have helped actually in boosting that performance as well of that particular market. And then the third phase is the one that I started talking about recently, today, which I'm really excited about, is where we can change behavior of our clients. I think that's a real game changer. When any sector, any company can issue a bond like that. And initially it will be a sustainable-linked loan, but you can see there will be an emergence actually of the sustainable bond market, of the social bond market. That will happen as well, in my opinion. And then you will also see innovative solutions in terms of wholesale deposits, retail deposits, which have basically a green angle to it, which is something that we didn't see before. Finally, I think where there's going to be a big shift, and it's something that Westpac and myself have been articulating for some time, is a recognition by the market in general that climate risk is financial risk. And I think that's a really important topic. And it's only now that the topic is gaining momentum. And it's gaining more momentum because both the RBA, APRA, and ASIC have all said now, and I'm sure that Jeff Summerhayes will reiterate that tomorrow when he speaks, they've all realized that climate risk is financial risk. What that means is that you have to price for that risk. And the pricing of climate risk is a new development, which is really important. So how do I bring that home? I spoke about sustainability-linked loans, where I'm going to give a discount on the margin of a loan to a particular client. So one might think your return, Didier, will go backwards. But I say that's only transitional, because over time, what you will see is basically that I will be able to lower the capital I need to allocate to that particular risk, which will compensate for that. And the pricing for climate risk is really changing at a very, very fast pace. It's changing not only in the debt markets, but also all of you in this room, you would all have ESG people looking at basically sustainability reports. I think actually now, it's about 90% of the top 500 companies in the US Fortune list now have to publish sustainability reports. That will only intensify and go to a next level. So I think we're getting this momentum that we never had before, Emma. Sorry for the long answer.
No, that's good. I mean, I guess that just leads to my next question, which is my final question, which is, if you think about perhaps that next phase being the system-wide change that's required across the sector, and initiatives like the Australian Sustainable Finance Initiative, the New Zealand Sustainable Finance Forum. I mean, if you were to adopt a crystal ball, what would be your ideal outcome from the impact that those sorts of initiatives could have in terms of the next phase of sustainable finance for our region?
There's 3 or 4 that spring to mind, Emma. Firstly, and I think it goes back to the objectives of one of the slides I put up before, if we can mobilize the capital to basically deliver on the goals and objectives of the Australian targets and contribute to the global targets, be it basically targets such as the UN SDGs, targets like the Paris Agreement, the Sendai disaster recovery frameworks, that would be amazing that we can mobilize that amount of capital. That would be the first one. The second one would be, it goes to this topic about having a more resilient financial sector. And it's not only about banks, it's also the insurance companies, it's superannuation funds, it's every part of the economy that links with financial sector, basically. We need to improve our understanding of the ESG risks that we are basically carrying in our own business, or the ESG risks of the entities that we do business with. I think that would be a second one that would be quite useful. And there's been an emergence. You referred in the introduction to a number of committees I'm chairing that didn't exist a few years ago. And I think we're ahead of the curve, and what we're seeing now is other companies are starting to do the same thing. Thirdly, and I think this is so important, is improved transparency. And I'm sure you're going to talk about that over the next 2 days. With TCFDs, of course, is front and center for all of us, but improved transparency, commonality of language, similar targets so that we can compare apples with apples, not apples with pears. I think that would be quite useful as well. And lastly, I think it's an opportunity also for the finance sector to regain the trust of the community. We've heard so many bad things, actually, over such a long period of time, especially the last 2 years. And maybe, in a way, this is a way to basically gain back that trust from the community and the economy at large, which I'm looking forward to.
Thanks so much, Didier. I really appreciate your comments. Thank you. Please join me in thanking Didier.